Welcome to the Scaleup Valley podcast, where we bring the best tech leaders in the world to help you scale from 2 million ARR to 100 million ARR. Today, we have a very special guest. His name is Stephan Morais, Managing General Partner at Indico Capital Partners. Stephan, thanks for being here. It's amazing to host you on the show.
My pleasure. Always a pleasure to try to contribute a little bit.
I'm sure that the Scaleup community will enjoy a lot this episode of the podcast. And yeah, let us know a little bit more about how did you end at Indico Capital Partners and how did you start in the venture capital industry?
Well, I guess that the route to become a VC is quite complex and is not standard. The first time I had contact with this world was when I was in London in the end of the 90s, and the ecosystem at the time was booming. The dawn of the internet age, and before I went to do my MBA, I had a chance to set up a little company with some other colleagues from Arthur Andersen while we were working at Arthur Andersen, and this was actually funded by the corporate that we worked for. And then when I got into Harvard to do my MBA, I tried to specialize as much as I could in private equity and VC. I kind of understood that this would be a profession that I'd like to sort of get into at some stage. But the truth is, I had done consulting. I then did banking. I then became a CEO. But I never lost sight of the fact that what I really wanted to do was to become a professional investor. So when the time came, more than a decade later, I joined the board of Caixa Capital, which was the VC and private equity shop inside the largest bank in Portugal. And at the time, I was a little bit lucky because I think the Portuguese ecosystem was starting to arrive to an interesting stage. There were a few companies that were really starting to make their marks on the international markets, both in Silicon Valley and also in London, and raising capital. And there weren't that many VC firms, and standard plain vanilla term sheets were almost inexistent in the market. So it wasn't actually too complicated to try to do something just normal. And very rapidly, I think the founders in the country understood that they had a partner that could sort of help them and help them secure capital, help them do other rounds, help them grow their companies. So we ended up putting together a very, very interesting portfolio of Portuguese-based companies, which did very well. Companies like Apple and Farfetch and Codacy and a few others. Basically, almost all the success stories coming out of Portugal, with the exception of Cristina's Fonseca Talkdesk, which now joined me in the fund. And that's how things started. I had this long-standing passion with the industry. But again, it's not an industry where it's obvious how to get in, right? You just don't really do a master's in VC kind of thing. Right. And so there's many routes, but I think it's a profession that it's good to have experience, and it's good to have been on many sides of the table. And given that I was a banker, consultant, and a CEO and a founder, I think that gave me the perspective of how to address the issues that founders face and the growing pains of companies.
Very, very interesting. And what about Indico Capital Partners? So what is your investment thesis? What is your mission, your vision? What are you trying to build now in this second stage after Caixa Capital?
Well, I guess we started with nothing too different from what we used to do at Caixa. The Portuguese ecosystem has obviously become a little bit more mature. There's also more foreign investors looking at deal flow here. But in essence, it's an early stage ecosystem where there's a lot of good engineering talent for a reasonable cost, which means that you can be quite capital efficient at the beginning, at least. Not so strong probably in human resources in terms of sales and marketing. So that's the kind of talent you have to acquire internationally. But there's a big advantage in the Portuguese ecosystem, which is that there is no local market. That means that the Portuguese startups, they really need to go global from day one. And that changes the perspective entirely on the way you develop product, the way you develop customers, and the way you price and so on. And so what we try to do at Indico really is to find companies that are potentially unique globally in the way that they're solving a certain problem, or at least a magnitude number of times better than anybody else out there, certainly in Europe, potentially globally, with a team that has the ambition to become a category winner at the global scale. And to do that, we basically deploy pre-seed to Series A capital and knowledge, and try to help the companies do that transition from being just an early stage product, post product in general, but with very, very little revenue kind of company into if you're talking about a SaaS company, a company that would have 100K plus MRR, and that is ready to receive new types of investors and bigger funds than ours from all over the world. We are quite flexible in terms of the stage that we get in. So we go in as little as 150,000 euros and as high as 5 million. And we have occasionally done Series A straight, or even a Series C that we did straight at Unbabel, because it was one of my former companies, and the opportunity came up to get in again with our own fund. And so we took that, but that's a little bit outside of the playbook. It also helps, I think, gives a better profile to the fund, in a sense that it's a slightly later stage opportunity that has less risk, supposedly. And so we're quite flexible, but I'd say that our sweet spot is to get in at seed rounds, anything from 500,000 to 1.5 million, and then help build a team, help build the recurring revenue side of the equation, and positioning the company into securing a strong Series A co-lead with us, so that the company can then fly into further markets and do well and keep on bringing talent.
Good. We always love to discuss on these episodes with investors on the perspective of helping their portfolios scaling up. That in the past, usually entrepreneurs needed to beg for money, and nowadays there is much more capital available, and it's much more the kind of the opposite. The very good teams, the very good entrepreneurs, the very good businesses, investors want to get in. Do you have any story of an investment where you needed really to fight in the good sense, of course, to get in?
I mean, currently in the current portfolio, we haven't had that experience yet. I mean, we started this fund only about a year ago, did 9 investments, deployed about 17 million out of the 51 or so that we have. So this was quite a busy year, and a year in a sense a bit unusual, because in the previous 2 to 3 years, maybe there wasn't so much capital available in the market, given that we had departed from Caixa, and the other teams that were VCs as well did not have funds operating either. So it was a year where we had a lot of potentially good opportunities that we suddenly invested in a faster pace than what would be normal. Having said that, we only invested in 9 out of the 1,200 that we saw in 2 years. So it's quite a low ratio, but still kind of easy to deploy. I don't think that in the future it will be this way. It'll keep on being this way. But if I had any issues with coming into deals, I think this happened more in the past, particularly when we were at Caixa, and when there were some specific restrictions given the corporate fund nature of it. And there, when you have less flexibility to decide on how you're going to deploy, the size, the type of security, the specific terms, sometimes it gets hard to sort of combine that into a winning proposition. But I'd say that in general, I can't remember a specific time where we had a big difficulty because, in essence, being an early stage market, the foreign investors, which could be potentially the largest competitors, effectively they use us more as suppliers of deal flow rather than specifically competitors to us, because they will tend to do bigger tickets and we will tend to get in before when the company is younger. So we don't feel the same rush. I think that in many of the more mature markets where there is a lot of capital, I think we probably went a little bit overboard, where there is an imbalance between capital and opportunities, and you see what you call typically bubble situations where people are paying sometimes huge valuations for essentially PowerPoints. We haven't done that. We will try not to do it. I don't think this is good for the industry, and certainly not for the investors in the industry. And we must not forget that VC is a small industry globally, even if sometimes for the people inside the industry, it looks like the whole world is VC driven in startups, but this is not the case at all. This is a very small asset class. And when you go through a period of low interest rates for a long time, there's more capital that moves into this little asset class called venture capital. And that creates sometimes some tensions and some imbalances between the power of investors and the power of entrepreneurs. Having said that, I would agree that most of the power now is in the hands of entrepreneurs because there's capital available, and the good entrepreneurs, the good teams are they can pick and choose the funds and the investors that will help them most. Lastly, in the last few months, we have seen a slight reverse to that trend, and we're seeing companies needing to become more efficient with better performance and probably larger rounds, chasing a fewer number of companies as opposed to more rounds generally and more capital for everyone. So yes, it's the power is in the hands of the entrepreneurs, but only the very good ones in the companies that are sort of hot for a reason or not.
Right. And it's usually on the show, we always cover three main ingredients that we consider critical to scale up, which are the team, number one, number two, much more related with strategy and also cash and funding rounds milestones, which is focus, and number three, execution. And the listeners might be asking, so if you tend to invest with Indico Capital Partners from pre-seed to Series A, why we invited Stephan Morais to be on this show. And it's the same answer that I did with Luis Martin Caviedes, that has been also on the show before. It's because I really believe that, first of all, Stephan has been helping those companies scale, and I've seen a lot of them scale very, very well. We are talking about companies, as he was sharing, and Babel, Farfetch, you can name it even more, Stephan, and something that we were also having a lot of fun with Luis Martin Caviedes is that if we don't have a good early growth stage and a good seed stage, usually the scaling up stage would be even more difficult. So starting with the number one, how difficult is this transition from a founding team to the first leadership team, from your experience, having a team just of helpers around the CEO and the founders to really start building the first version of the leadership team?
I think maybe a couple of comments on that. Number one, regarding your analogy between the need to have a good early stage to have a subsequent robust scaling up process. I always like to sort of compare what we do with a football training academy or football school, right? If you don't really have the Barcelona football school or the Benfica or Sporting football school, the Ronaldos and the Messi are really.
Stephan.
I'm a Benfica fan.
Stephan is from Benfica, yeah, right?
But I'm from Benfica. But I must say that Ronaldo came from Sporting, so they have a pretty good academy as well. And Messi, I think he grew in the academy of Barcelona, right? If I'm not mistaken.
Yeah.
Although he's obviously from Argentina. But the truth is, I think that there's a number of things you need to do when you're an early stage VC, which are not too dissimilar from finding Ronaldo and Messi when they were 6 or 7 or 8 years old. You need to find these sort of talents, the team. You need to find these amazing entrepreneurs that have the drive, the passion, the ambition, and also the technique. They need to know what they're talking about. They need to put in the hard work, all the same as a top football player. But the truth is, if they don't go through a good training program, they will not reach the Champions League. There might be mistakes. There might be accidents, they might break a leg when they're 13 or 14 and never make it to the pros. But if you don't have the right academy, which means if you don't have the right early stage investors, the likelihood that you're going to end up in a top fund when you're a grown-up startup, right? Which means the likelihood that you're going to end up in playing for Manchester United or Barcelona or whatever, one of these top clubs, is very low. Again, the analogy with Ronaldo would not be the player he is if it wasn't for his move from a little club in Madeira when he was a kid into the academy of Sporting, right? And it was Sporting that gave him the projection to become then a Manchester United player and then subsequently Real Madrid and so on. So you do need the academy. You do need the early stage local investors, because that's also something else that confuses founders sometimes. They sometimes think that they can go from like a PowerPoint into a major sort of London-based fund that basically invests in Series A and above. It might happen, but it's highly unlikely, right? Because the Manchester United scout is not going to go to Madeira every weekend to check the 6-year-olds, right? So there's a chain, there's like a system, there's a process. And you have to go from your little local club or playing on the street to going into a national champion kind of club, which is one of the top early stage VC funds that exist across Europe in each country. And then there's a number of top VC funds across Europe, which are the big league, right? Essentially, they're pan-European, they're huge, they have a huge network and so on. But all these players are needed to create these superstars in terms of unicorns, which could be our Ronaldos and Messis. And so I think that's the first thing that it's important to sort of clarify when you're talking about team. And this training process is in this transition that you mentioned, which is going from founding to leadership and going from a pre-seed into suddenly you're hiring lots of people and your revenues are increasing, but also your complexity is increasing. Requires that founders have good listening ability. They need to be able to adapt. They need to be able to tap into the resources of the VC, in particular the partners, which are normally more experienced in many areas of sort of growing up the company. And so it is important to have that cooperation, that ongoing learning from side to side, where we can, as investors, share our knowledge and with past experiences, and that the entrepreneurs adapt to their changing role of being coding to becoming managers and to becoming leaders of a good organization, and that is only done. That can only be done if there's a very close cooperation and communication between founders and investors, because let's not forget they're all shareholders, right? In the end, translating into sort of like company talk, these are shareholders in the company and they're all owners, right? The investors and the founders are not different in that sense. They're shareholders, and all shareholders deserve the same respect, and all shareholders in this case can add value, at least theoretically and hopefully.
Right. Very, very good point. And we always talk a lot about on the show about the importance of the CEO. We on the 100 plus episodes so far, with the majority of them were with CEOs, and they admit a lot on the show that they need to become a different person for the multiple companies that they will be leading if they are able to get to the major milestone that we all expect, which would be the IPO or the acquisition. So how do we help them? And sometimes they are even self-aware of that, but they can be really their own bottleneck and their most important enemy to shift of personality during this way. And we must say that those cycles are very aggressive. So every 12 to 18 months, if we are successfully raising a round or doubling or tripling the business, the CEO that needs to be hired for the next round has very different skills than the previous one. And we are trying that the founder keeps at the helm of the company. So how do we help them, and what is your experience with that?
Yes, I mean, I think that you've touched the point. It's not really about changing personality, because that's kind of hard when you're a grown-up, but it's about having extra skills, right? And it's also about surrounding yourself with the right types of people. One of the things that we do quite a lot is help companies acquire talent, in the sense of hiring really good people, complementary people that quite often are even better than the CEOs or the founders in their respective fields. Attracting senior, experienced people is absolutely key once you can afford it. The difference, the proven difference between companies that really go big and have huge acquisitions or are acquired for huge sums or do the IPO, and the other ones that keep on growing but maybe not so much or even struggle, it's all about the people they hire, right? Because in the end, the founders, they need to adapt, they need to reskill, they need to know what are their difficulties, and they can either build up their skills themselves, and or they can hire more people, and people which become more senior. There's an issue sometimes that happens, which is some of the founders, they really are very focused in one area, particularly a technical founder, and they need to adapt to the fact that there will be other potentially more senior people joining the company, which will be more senior than them, because they don't want to manage. They want to have, they want to be great at what they're already great, which is on the technical side or whatever it is that they're great at. And so that requires a lot of self-knowledge and self-awareness. And that's not easy. I mean, some people have more self-awareness than others. And you have to be, essentially, I think you need to have emotional intelligence. You need to be a good listener to understand what are the drivers, not only of the business, but also of the investors and of your employees, because culture can change a lot also when companies grow very fast. And you have to make sure that the culture that is evolving is the right culture for your business, that represents the values that you want to uphold, and that represents the growth trajectory that you want to impose on your company. So it's not an easy task. I think not everybody is ready for that. I think age also helps a little bit. I think that when you look at the successful founders in the Valley, you see that the average age is probably higher than the ones in Europe. That's obviously a factor that we have to take into account, because Europe is a younger ecosystem. It also has its advantages, but I would say that people have to mature quite quickly and have to adapt, take some things very seriously and take others not so seriously, in a sense that you have to prioritize and know what's really worth fighting for, and what are things that you have to just let burn, and that's it.
Absolutely. And what are the positions or that you consider more difficult to hire as part of the first version of the leadership team?
I'd say when we reach a stage where the company has done a successful sort of seed round and is evolving into becoming a Series A, that's when the big transition occurs. Typically at that stage, the company has a product, is working fast towards product market fit. And that means that it needs to start having some serious talent around sales and marketing, which is sometimes not natural for the founders. And the founders tend to be more technical globally. When you get these sort of people inside, potentially coming from other startups or or corporates, sometimes the fit is not the right fit. So we try to advise founders to really focus on cultural fit, personal fit, because these will be very, very senior people that the founders will work with very intensely. They did not come from day one, so they do not necessarily share the same jokes and sort of conduct and process. Right. But at the same time, theoretically, they will come with vast knowledge on how to get things done in a faster and more efficient way, right? And how to scale. And so that transition, those roles, particularly in sales and marketing, sometimes they're the most challenging, particularly when you're talking about markets which are more peripheral, say like Portugal and Spain, where you don't have the same amount of trained talent as you'd have obviously in Silicon Valley or in London. And so to attract that kind of talent, to integrate them culturally, to make sure that they have the right conditions to be successful and that they're allowed to contribute, all those clashes need to be managed and need to be taken care of.
Got it. And moving to the second point that we always discuss, which is much more related with focus. And this one I've heard from you several times, and I've learned a lot the way you are so structured about what needs to be proven in each stage of investment. And I always like when I see someone talking about very few points, because it seems that they know something about what they are talking about. So it's very easy to complicate. And sometimes when we are scaling, it is very counterintuitive. We tend to open up the avenues of growth and try to go to too many geos, serve small business, mid-market, enterprise at the same time, serve all sectors or all verticals at the same time. So what kind of advice or what kind of mistakes and what do you try to avoid in your portfolio in terms of assuring that they get more focused instead of being distracted with so many battles?
I mean, clearly, the younger the company, the more they should focus, at least to the point that they need to find who are the typical early adopters and what is the segment that they're going to have their first, big win in terms of customers. Because what we see quite often is that right at the beginning, you have to be a little bit broad because you might not know who are the customers. But once you zero in on who are your champions, then you have to double down on that. Only later you can then start to address other segments or increase your product breadth or the geographical sort of spread. And this is basically just a function of resources, right? If you don't have the resources to do everything, you just can't do it, right? So I think that there's also a natural correction in that process, but obviously VCs tend to be, if they're more experienced than the founders, which is also not always the case, but if that's the case, they need to be sort of on the lookout when you're working with the entrepreneurs to try to help set strategy and to set priorities and to set OKRs and to set, who does what when. Right. It is often, I'd say that this is actually like, when you're trying a new sport, you're probably going to hurt yourself when you have no idea what you're doing or when you're really good at it, right? That's when you fall when you're skiing, right? You're starting or you're really a pro and then you hit like a rock. And the same thing might happen with startups, which is at the beginning, you have probably no idea what you're doing. So you might hit, a few bumps in the road and you might sort of hit rocks as well. And then there's a phase where basically you are focused and you know what you're doing, you're getting better and so on. And then you get a little bit overconfident quite often. And signs of overconfidence manifest themselves quite often in overhiring people, because you've raised a big round, you allow yourself to have lots of people that quite frankly have no time to integrate them and they have no idea what they're doing. But you're kind of detached because you're the founder and you have all these people below you and you don't know exactly, and have these middle managers that should know what they're doing, but they don't know either. So it's, overhiring is a sign. The other sign is, feature proliferation inside your product and trying to have many products or way too many features in the product before they're actually needed. That will just increase your complexity and actually might bring down the whole thing. And the third is geographical dispersion, right? And while it's obviously normal to go into different geographies, particularly if you're in Europe, right? These are all small countries, so you have to conquer many to make yourself a big company. But what you probably should not do is have lots of product launch and lots of country launch and lots of people coming in at the same time. because it's just also not human. It's not humanly possible to manage that sort of chaos. And I think that a lot of times, because you have raised subsequent rounds at higher valuations, you might even have a feeling that your stake is worth, X amount of million. And so you probably believe that you're, doing very well. And you kind of lose focus that actually, all startups, until they become really, really big, are actually very small companies at the global scale. You see that as well when companies do IPOs, and they tend to they had a very successful VC career. Let's put it this way: they've raised with great investors, on very founder friendly terms and so on. And suddenly you reach, the capital markets, the big boys club, the financial analysts, and they sort of shred you to pieces, right? Because you're just another company, within the New York Stock Exchange that has thousands of amazing companies that nobody has ever heard of, and they're much bigger than you, and so on. So all these transitions, even the IPO is kind of just the beginning, right? So we can never lose focus of how small we are. We particularly, on the early stage side, we're just dealing with the little kids, let's put it this way. We're trying to find the little Ronaldos, and we have to be humble about it. But the companies also need to be humble about it. And they need to understand that this is a long-term game, a very, very difficult game. In the end, there's very few messes in the world.
Very good analogy. Loved it. And usually this temptation also comes from the huge pressure on the milestones that companies need to achieve on this industry. We tend to talk about triple to double free rule in the show, and usually when the founders needs or the CEO needs to find out a plan with the leadership team to double or triple the business every single year, there is this pressure of the fear of missing out any avenue of growth that tend them to try to invest everywhere. So if they fail in one of the avenues, at least they might have a success in one of them. And when they fail in everyone, cash was all allocated, and there is no milestones for going to the next round, which is kind of a cash strategy problem. So what do you think first about the ambition of doubling, tripling every year? Do you think this is something that needs to be done, or it depends? And second, how to solve this issue when we spend too fast, we allocate too much capital, and we don't get to the milestones, and it puts ourselves in a very difficult situation to survive and move forward.
I'd say that in general, the VCs are becoming more data driven. As anything else, any other industry in the world, this is the general trend that has to do with the availability of data, and so what we see is that VCs, depending on the type of business, are more and more focusing on numbers as opposed to only intuition. So when we talk about milestones, we're talking about once the company grows, the investors they act more like investment bankers, in a sense that you have comparables, you have other companies in the similar markets which have achieved certain trajectories, and therefore it's unavoidable that people find that they can only invest, or they can only keep on supporting companies which are following a specific path, and that is why these sort of rules come up. This specific rule is just a general rule, but then you would find that behind the double, triple, there's lots of other contribution margins, cohorts, and so on, lots of other small metrics which supposedly show the healthy trajectory or not of the business. I don't think that trend is going to go away. I think that what you're seeing is that increasingly, again, to the point that there's less companies raising more capital, and there's less winners overall, but the winners win big. There's inequality for sure also in the startup world and in the VC world. It's kind of a winner takes all kind of world. And so to prove that, you have to follow these metrics. It doesn't mean that there's no way out, or that the company will stop existing if they don't hit the numbers. But it might be that you just have to sort of exit a little bit sooner, or merge it with something else and get your money back. And that's why pref shares exist, and so on, to protect investors against those kind of scenarios. But unfortunately, the VC world and the startup world is not for every single company. We're really talking about the very, very few companies that will do well, in a sense that they'll become big companies globally. And even those, as we've seen, they reach the IPO and they still get knocked down by the public markets now and again. And this again depends on the macro situation of the world. Essentially, it depends on interest rates. It depends on whether there's liquidity in the market or not. And so the VCs, they basically are a translation of what the investors in the VC want, right? We are essentially managing money on behalf of institutional and private investors. They could be pension funds, and pension funds could be people like you and me that put their money into a pension fund. And so that's how capitalism works, and we just respect incentives, and we reply to incentives. And if the incentive is for the asset class to perform, otherwise people will put money into buying more real estate or buying a Ferrari. We have to come up with the returns to convince them that they should keep on investing in startups and innovation, or else they'll just buy stocks and bonds, German bonds or whatever it is.
Got it. And we move to the last topic of the show, which is execution. Nowadays in the tech industry, everyone is talking about one-on-ones, weeklies, monthlies, quarterlies, OKRs, the offsites culture, of course. What are some of the habits of the world-class teams that you have been seeing? So there's any habits or any pattern that you see in companies who execute well?
I mean, there's one habit which is definitely, if you take out of the equation capacity, right? Let's assume that everybody is able in the same way, or the people that execute are smart and they know what they're doing. I think what really differentiates people is the level of ambition, number one, and attention to detail, number two. What we see, the difference between the very high performing teams and the ones that do kind of well or not so much, it's that they are relentless about the sort of level of ambition. They really aim for the stars in a realistic way. I'm not saying these people are crazy and they're just saying things that make no sense, right? I'm assuming that people are intelligent and they know what they're doing. They really aim for the stars, but then they control every single detail quite deeply, right? So they work hard, which means that they work very hard, and they're very organized, which is something which is also very important if you want to do something proper. You have to be organized, and you have to work very hard, like in any other industry or any other school or university that you go into. Nowadays it's a very competitive world. So if you don't take care of details, if you don't aim really, really high, the likelihood of doing well is very low in today's hyper competitive world. And I'm not saying this is good or bad. It is just the way it is. And I think that we have, as investors, need to, help the entrepreneurs and the founding teams, train them and give them the tools and support them in a way that they can achieve their best. But obviously, the companies are run by the founders, are run by the executives and the leaders that are there day to day. And they really need to shoot for the stars and be paranoid about details. Otherwise, it's kind of hard to make it big.
Yeah, and I would like just to add something that I shared recently on my own LinkedIn, which is all about communication. And you also explained this very well, Stephan, how the VC business industry works. So unfortunately, it's very, very common to see that leadership teams don't understand how a VC business works. Middle management don't have a clue, and usually the bottom don't have a clue at all, which is very dangerous for 100 plus company who the majority of the company doesn't know what the game is. So I think that we should all invest more in and have more Stephans and talking in our companies about how a VC business works, and we can dedicate a further episode about this, because I really believe this is a very important investment that I'm more aware of. So we come to the last question and our favorite question of the show, which is, if you would have the opportunity to meet yourself, and let's go a little bit behind at the beginning of your career at Caixa Capital, what advice would you offer to Stephan, to your younger self?
I think that people now are very lucky that there's a lot of information, and I think there's more choices in life, because suddenly you just know that these things existed. When I graduated as an engineer, I didn't even know venture capital existed, right? So there's a lot of stuff that I think, there's a lot of people that reach out to me, young people that want to have some advice and so on. I end up meeting most people sooner or later, because I think that I feel that I should have probably reached out more to older people, to more experienced people, to sort of ask them, what can someone like me do, right? Here's who I am, here's what I like, here's what I'm good at and not so good at. Share with me what you think, right? And I think that's very smart when people do that, because we don't know what we don't know at any age, and even less when you're a teenager or a young graduate. And I think that, probably I should have done that more, even if people wouldn't reach out to me. You probably, you look at your time horizon in a fairly limited way. You look at your degree only, you look at your MBA only, you look at your early career, but you're not thinking long term. And it's not that people should be paranoid. And I think that, kids already have too much pressure nowadays. But actually having the knowledge to understand what are your career options, what are you good at, and where you should focus. I think that's something that I would have liked to have done more, and maybe I would have been a VC even younger.
That's awesome, and we have a very good case of Aris Tevings, also part of a very famous podcast that I strongly recommend, which is the 20-minute VC, and also part of Strides with Fred Destin, if I'm not wrong. Destin as partners. Thank you, Stephan. Stephan, it was really a pleasure to have you on the show. Thanks so much for making the time.
It's my pleasure. Cheers. Bye-bye.
To our community, thanks for being on that side. We keep here bringing the best people in the world to help you scale from 2 to 100 million ARR. See you soon and keep scaling.